The historically high growth in the housing market over the last year or so has been, in my opinion, largely driven by strong fundamentals, and as a result, the housing market is strong right now. But there are some risks, of course, out there to property prices that investors and pretty much any type of home buyer should pay attention to. And the most important of all of those is rising interest rates. Interest rates have a huge impact on housing demand and prices. And honestly, I think it's something that most people underestimate. So today we're going to talk about what happens when interest rates rise, which they will, you can count on that, and what it means for real estate investors and the housing market. What's going on, everyone? This is Dave Meyer from BiggerPockets, and I really hope you're all doing well as we roll into the holiday season. If you're like me, you have seen a lot of recent news about high inflation and interest rates starting to go up, bond yields are moving, and it's made me start thinking a lot about what will happen to the housing market as interest rates rise, because it is a super important factor in the housing market. So today we are going to cover everything you need to know. What is happening with interest rates right now? Why are they going to rise? And of course, what could happen when rates actually do rise? But before we jump into this, please make sure to subscribe to the BiggerPockets YouTube channel, throw us a thumbs up, and if you are feeling extra generous today, you can follow me on Instagram at The Data Deli to get more real estate analysis and insights. All right, let's talk about interest rates. Since the beginning of the pandemic, and actually a little bit before it, mortgage interest rates have been low, and since the pandemic, they have been near historic lows. And just for a quick note about what I'm talking about in this video, when I say interest rates, I mean the average rate on a 30-year fixed rate mortgage, simply because that is the most commonly tracked data. And I know this might not be the exact type of mortgage you use, or for investors, you might have a higher down payment or rate, but the lessons here are applicable to pretty much any type of mortgage or amount. So I'm just gonna use this one data type for this entire video. So what's going on with interest rates is that they've been super low and still are, but they are starting to climb just a little bit so far. The average rate has hit 3.16% recently, which is really low, but is up nearly 20 basis points from the last couple of months. While I do believe this is the start of a long-term trend of rising rates, this change is really pretty modest at this point. Rates are still incredibly low in historical terms. You could just check out this chart. And over the course of history, we're still pretty much close to rock bottom mortgage rates. But rates are likely to rise, and in a minute, I'm going to explain why rates are going to rise. But first, I want to talk about why interest rates even matter to the housing market in the first place. To put a long story short, interest rates dictate the cost of a mortgage. So when interest rates are high, the borrower pays more interest to the bank. When interest rates are low, the borrower pays less interest, which is great. The interest is the bank's profit. So as a borrower or an investor, you want to pay as little interest as possible. So I made a mortgage calculator in Excel to show you guys how this all works, and we're going to walk through this right now. All right, so what we have here is a basic scenario that I set up just to demonstrate how interest rates impact housing affordability and ultimately housing prices. So the median housing price in the US right now is about $375,000. So you can see right here for purchase price, I have $375 grand. For the purposes of this example, I have 20% down, which gives us a loan amount of $300,000. For our example, I'm using a 5% interest rate, which is just way higher than things are right now, but I just want to make a point here. For a $375,000 purchase with a 5% interest rate, your monthly payment is $1,610. All right, sounds pretty good. And our interest cost, the amount of profit we are paying to the bank, this doesn't help us in any way. All we are doing with this $280,000 is making the bank money. So I'm just going to write this down here so we can save it. So in the scenario one, we have $280,000. So I'll just put 5% interest rate here. And then let's look at what it is now, which is a 3% interest rate. So same purchase price, same terms on the loan, except I'm dropping the interest rate down to 3%. Look at this. The interest cost just dropped to $155,000, and I'm rounding here, so give me a break. But look at the difference. So I'm going to divide this by this, and subtract 1 to get the difference. And then I need to make this a percentage. Negative 45%. We are seeing that by dropping the interest rate from 5% to 3%, the amount of interest we are paying, and that is money that is going to the bank, drops 45%. We are saving ourselves $125,000 over the lifetime of this loan just because the interest rates drop. So if you're wondering why, or if you're confused by why housing prices have shot up over the last 2 years, look at interest rates. Yes, there are things like supply and demand that are impacting what is going on and changing market dynamics, but at its core, homes are just more affordable to people because interest rates are lower. To further demonstrate this point, let me just show you guys something. So we are seeing that if we drop this to take this back up to 5%. Remember, our monthly payment was $1,610. So let's assume Dave, could afford this house. At 5%, I could afford a $375,000 purchase because the monthly payments were $610, and that works for me. Now, if I drop the interest rate to 3%, we know that our monthly payment is going to go up, but let's just see what happens here. I wanted to buy now a house that's $475,000. So I'm looking at a house that is $100,000 more than what I was originally able to afford. And look at this, it's $1,602. So I could buy a house. If interest rates drop from 5% to 3%, I could buy a house that is $100,000 more expensive than the original one I was looking at just because interest rates dropped. And I know, yes, I would have to put more down on that, obviously, for the more expensive house. But my monthly carry, in terms of my principal and interest, would stay exactly the same. So hopefully you can see how this impacts the dynamics of the housing market. Because interest rates are historic lows, it means that people can afford more and more house, and this pushes up housing prices. Now, the opposite will happen when interest rates rise, right? So let's say I buy this house for $475,000 and interest rates, or I'm thinking about buying this house at 3%, and 1602 is in my comfort zone. But let's say a year from now, I go to buy a similar house and interest rates have gone up. Now my monthly payment is $1,814. So it's gone up by nearly $200. And this is a hypothetical scenario. I don't know if the numbers would still work, but hopefully you can see that just by interest rates going back up to 4%, carrying costs are significantly higher. Cash flow is going to decrease for rental property investors, and this weighs on housing property prices. This is why rising interest rates have the potential to hurt the housing market. Rising rates make properties less affordable. Fewer buyers will be interested in a property that has higher interest rates, and higher rates increases the debt to income ratio of the loan, and therefore fewer buyers will qualify for a mortgage on this example property. Or in other words, high interest rates lessens demand, and when demand falls, housing prices can fall too. That is the basics on why interest rates even matter to housing prices. And now let's get back to something I said earlier, which is that although interest rates haven't really risen yet in any sort of significant or meaningful way, they are very likely to, and I want to explain why pretty briefly. So there are two primary indicators to look at when it comes to mortgage rates. The first is the federal funds target rate, and the second is yield on the 10-year Treasury note. I know this sounds like crazy, weird things, but let me just explain it to you. First is the federal funds rate, which is the rate the Fed sets for interest rates. And this currently sits near zero, which was done at the beginning of the pandemic because cutting interest rates is a tool to stimulate the economy. So when interest rates are low, it gets more money into the economy. This is also known as increasing monetary supply. And this helps grow the economy in recessions like the brief recession we saw in 2020. And in an ideal world, the Fed would probably keep interest rates low for probably a year or two and then raise them very gradually, like a quarter of a point at a time. Because this is what they did last time rates were near zero, which was during the Great Recession. But one thing is working against this plan, and that is inflation. You've probably heard inflation is on the rise. Everyone has heard this. It's all over the news, and everyone basically just hates inflation because it decreases the value of your money. The Fed targets about 2% inflation annually, but right now we're actually at 6%, and no one at all is happy about that. Now, I personally don't think it's time just yet to panic about inflation, but it is high and it is concerning. And the Fed is likely going to have to act to curb inflation soon. And the way they do that, the way that the Fed curbs inflation, their number one tool for doing that is raising interest rates. Because raising interest rates lowers monetary supply, which helps curb inflation. As of now, the Fed has signaled they're not likely to raise rates until late 2022, so we're probably about a year out from that. But it is something to keep an eye on because if inflation stays high, they could have to act sooner than they want to. The second indicator for mortgage rates is the yield on the 10-year U.S. Treasury note. This is one of the most common types of bonds issued by the U.S. government, and yields have been going up. And when yields go up, so do interest rates, on mortgages at least. This is a whole pretty complicated topic in itself, and honestly, it's probably better for another whole video. But for the purposes of this video, please just trust me, or if you want to, you can Google it. But mortgage interest rates are very closely correlated with 10-year Treasury yields. And although yields also, just like mortgage rates, remain very, very low, near historic lows right now, they are starting to inch up for a few reasons. I'm not going to get into all of them, but the main reason, at least things have been moving recently, in my opinion, is that the Fed announced that they are starting to taper their asset purchases. And this is sending yields up and is likely the cause of the modest increase of mortgage interest rates of late. Yields are at historic lows, but the Fed is reducing stimulus and inflation is here right now. And it creates this condition that bond yields are likely to rise, but probably pretty slowly. So just to recap, we have two major indicators for mortgage interest rates. It's the Fed's target rate and bond yields, both of which are likely to rise over the coming years, albeit at modest rates. And this will send up mortgage prices. It will. The question is really how quickly rates will rise and what the impact on these rising rates will be on the housing market. To answer that question, let's turn to some historic data. So I grabbed some data from the Fed, which is you can get, it's publicly available. And I have plotted two different data points on a single graph. So this red line here is the median sales price of houses in the United States. So you can see it going up since 1975. And you can also see the average mortgage rate in the United States. Again, we're using a 30-year fixed rate mortgage. And you can see that just declining. So it's pretty crazy to look at this. And the first thing that is obvious here from looking at this is that these two data sets are negatively correlated. And a negative correlation means that they do have a relationship. It's a strong relationship. But it means that when one data point goes up, the other one goes down. You can see this. These lines are crossing exactly as you would expect with negatively correlated data sets. So that is typically what happens. But that is not always what happens. And I think it makes sense to zoom in here and just look at what's gone on really since the Great Recession, which you can see designated by this gray bar here. So we saw interest rates decline starting at the crash and bottom out here in about 2012, where interest rates were rising. That's what you would expect, right? Rates go down, prices go up. But then look what happens. In 2012 up until 2013, rates go sharply up, but housing prices go up. That's not what you would expect. Then rates go down, then up, then down, then up, then down, then up, then really far down. All the while, housing prices have been going up. And yes, during 2018, we did see with this spike in interest rates, housing prices start to flatten, but prices didn't really decrease in any meaningful way. And of course, everyone knows what's happened since this brief recession in 2020. We've seen housing prices explode. And the reason I'm showing you this is that there is this narrative that housing prices always go down when interest rates rise. And that is just not the case. As you can see, that is historically what has happened. But from what I see, we are in this new era of mortgage rates, right? So back in the 80s, mortgage rates peaked at 17.5%. Can you imagine that? That would be insane to see something like that. And they've just been on a downward trend. But since the recession, where monetary policy has changed a lot, we haven't seen the same correlation between home sales and interest rates. We saw that pre-crash. But since then, the dynamics between these two data sets have changed a lot. So I don't think we necessarily know that if interest rates rise, that home prices are necessarily going to go down. It is likely if they rise quickly, they'll go down. But really the question is, how much are they going to go up? So overall, even though we're in this unprecedented period and we don't know exactly what's going to happen, if we had to bet, the most likely scenario is that when interest rates rise, home prices are going to be negatively impacted. What does this all mean, right? What does this mean for investors? So let me get into three things that you should understand about this whole situation if you're a real estate investor. The first here is an absolute no-brainer. If you have a property and you haven't secured a refi on that property yet, you should do that, because if you intend to hold on to a property for a long time, interest rates are about as low as they're ever likely to go, and you're not going to go wrong locking in an interest rate if you're going to hold on to a property for a long time. The second is kind of similar to the first, is while the market outlook is unclear in the 2 to 5 year timeline, locking in a 30-year rate at historic lows for a new purchase is likely going to be a good idea for investors who are in it for the long game. Even if prices fluctuate in the next few years, holding on to historically low interest rates for over 20 or 30 years is likely going to be a home run for you. And the third thing, of course, that you need to pay attention to is the biggest thing, and that is the impact on property values. And in my mind, what happens here all comes down to how fast rates rise. If rates rise quickly, it could and probably will cause a shock to the system, and housing prices could either flatten or actually start to slide backwards. But the Fed is not likely to do that. They will likely try to raise rates as slowly as possible to allow economic expansion and wage growth to counteract the impacts of rising rates. See, rising interest rates have these downward pressure effects on housing prices, but wage growth and economic expansion have positive impacts. So if they work and both things can sort of counteract each other, you can see housing prices continue to rise even as rates rise. And this is what happened in the post-recession economy. It was one of the strongest periods of property growth in American history despite rising interest rates. So that is, I think, what we all hope happened, that we see something similar happen to post-recession, where the economy is booming, wages are rising, and the housing market can grow at a steady, healthy pace. But that said, if inflation stays too high for too long, or even maybe it even starts to accelerate, we have no idea, the Fed could be forced to raise interest rates faster than they want to, and that could hurt housing prices. So that's something to pay attention to. But before I go, I just want to make one thing clear. When I say rising rates could hurt housing prices, I am not necessarily saying this would be a crash. In my mind, a crash is a drop in asset values of 20% or more, and I think it's very unlikely that interest rate hikes alone would cause that kind of decrease. Instead, I think rapidly rising rates on their own could lead to a period of flat growth or modest price declines, maybe modest price declines, but not 20% crash in the coming years. Of course, if rising rates were coupled with something else in the economy, like a sharp increase in housing supply or a big drop in demand, that could cause a crash. But if you watch any of my other videos, you know I think that is personally unlikely, at least over the next couple of years. Instead, my outlook remains pretty much the same despite what's going on right now. I believe in 2022, we'll see solid price appreciation because interest rates are not likely to rise very rapidly. But once mortgage rates rise to around 3.75 or 4%, which I personally believe will be in 2023, is where values could be negatively impacted. But we really are honestly a ways away from that. And given how novel and unique the economic circumstances are right now, I don't think anyone, myself included, has enough data at this point to accurately predict what happens beyond the next 12 or 18 months. So for right now, it's just important to remember that interest rates are likely to rise. So if you're investing for the long run, securing a good rate right now could be a good idea. And as rates surpass 3.75%, that I think will be at least a year out, demand could be negatively impacted. It'll be really interesting to see what happens with the housing market at that point. All right, thank you guys all so much for watching. I'm Dave Meyer from BiggerPockets. You can find me on Instagram at The Data Deli, or I'll see you all here on YouTube next week. Thanks.